What's up, guys? It's Mr. Fit to Flourish, and this is part 4 of the options trading series, how to trade options. Today we're talking in depth about the Greeks. So the Greeks are pretty much the formula, the things that go into the options formula and how options are priced, okay? And the main ones that we need to know are delta and theta, really delta and theta, and then we need to understand what IV is as well. Okay, so number one is delta. So delta tells us how much an option's value will increase or decrease with a $1 change in the share price. So if my stock goes up $1 or down $1, this tells you how much that the option contract will gain or decrease with that $1 move in the underlying asset. Okay, it's also equal to the percent chance of the option becoming in the money at some point before expiration. But the main thing we need to know is how much the option value will increase with the $1 change in the share price. That's really the main thing. Okay, so if delta is listed as 0.64, then that means that there would be a $64 change in your option contract price if the stock price changed by $1. It was pretty serious, pretty significant. Okay, let's take a look at what that actually looks like. So delta in action. So let's say that you buy a call option for 0.5 or $50, okay? And it says that for that call option, the delta is 0.25, $25. So that means that if you buy a contract for $50 and the stock price increases by $1, then that means that my call option would increase by $25. Okay, so let's take a look here. So if the stock price is $100 and it moves to 101, then the contract that I bought was $50, and off of that $1 move, now it's at $75. So that's a 50% gain. So one thing I like to look at when I'm looking at contracts is I like to look at the delta to contract price ratio. So 25 to 50 is 1/2 or 50%. So that's pretty big. So that means off of a $1 move, I can make 50% of whatever I put in. So if I put in 10K, I'm making 5K in a matter of like minutes, if not seconds. Okay, so I kind of like to pay attention to that a lot of the time. And then from 101 to 102, then I would gain an additional $25. So 75 to 100. Okay. Now gamma. So gamma tells me how much delta will change with the $1 change in the stock price. So it's the speed at which the option prices change. So for instance, here I showed we went from 50 to 75 to 100, when in actuality, after we go from 50 to 75, that delta will change from $25 to something higher like 28 or 29, because we're getting closer and closer to the option strike price, or we're actually moving in the direction that we think the stock is supposed to go. Okay. So gamma just tells me how fast delta is going to change. Now, theta is one of the most important ones when it comes to swing trading and option contracts, like holding option contracts, because it's your pay to play. Okay, so it tells me how much the value of the contract will decrease every day, keeping the share price implied volatility constant. So what does that mean? So if it's negative 0.64, then that means that every day that you hold this option contract, it's going to decrease by $64 a day. Because once you get closer to the expiration date, your contract is losing time and therefore decreasing in value. Okay? So theta tells us how much it will decrease every day. So for instance, theta in action. So if the stock price is $100 and it doesn't change, but the days change. So for instance, theta is negative 0.1, and that same $50 contract, we hold it for day 1 to day 2, that contract goes to 0.4. Then it goes to 0.3 the next day. And that's pretending that the stock price doesn't change, but we're only taking into account theta being negative 0.1. That's how much the option contract will decrease every day. All right, and then when it comes to Vega, Vega is not really important, but it's how much the option's value will change with a 1% change to implied volatility. Like I said, not really important. But yeah, those are the main Greeks there: the delta, theta, gamma, and Vega. And then implied volatility is another factor that goes into calculating options. Okay. So volatility describes how much a stock changes on a day-to-day basis, up and down. So the more volatile the underlying, the more volatile the option can be. Implied volatility So it's the volatility of an option based on what the market believes the option is worth in real time. So options get more expensive around current events. So for instance, when there's earnings, you'll typically get a huge spike in volatility because people believe that the contracts are worth more and are willing to pay more money for that contract, because there's an event that can cause huge fluctuations in prices. Therefore, people are willing to pay to play. Okay, so implied volatility, it's a real-time indicator of how much the market is willing to pay. Like I said, how much they're willing to pay for an option contract at a given time. So IV can spike during events or with news. So if you're swinging, the rule for swinging options, so you're holding on to an option contract for more than a day or two, you want your IV to be less than 50%. Okay, if it's more than 50%, then you're going to get huge fluctuations in prices. And I've seen before where someone would pay $5,000 for option contracts when the IV, the implied volatility, is over 100%, meaning that there's a lot of just made up volatility, made up price. I call it air or fluff in your contract price. And that 5,000 quickly went to $100 the next day because there was so much volatility, and it was what we call IV crush. And that usually happens during earnings when the IV, the implied volatility, goes up over 100%. Therefore, there's like a lot of fluff, made up price in that option contract, made up value, and then the next day it can go to zero. So be careful trading contracts with IVs over 50% if you're planning on holding that contract for more than a day or two. So like I said, the IV typically spikes during earning events, and higher volatility means there's more risk involved. And if it's more risky, then the contract becomes more expensive. So a little bit more about implied volatility and earnings. Again, during earnings, IV typically spikes over 100%, which basically means you're overpaying for the options, okay? And it could go to zero next day, like I said, especially if you're too far out of the money. Okay, you're pretty much gambling, holding overnight during earnings, and I really recommend not doing earnings gambles. A lot of people are like, oh, like earnings, but don't do earnings gambles unless you're willing to accept the total loss, because there's a lot of the times high probability of total loss, or unless you have insider information, or unless there's overwhelming evidence of one direction over the other. Okay, so be careful trading options during earnings. And again, the most important option price factors are going to be theta. It gives you, so theta, again, give your options time to get to where you want it to go. Delta, look for a good delta to contract price ratio. And it's a pretty easy way to kind of guesstimate how much you can make for every dollar move. IV, so the IV needs to be less than 50% for swings, and then volume. So the volume is how many trades are executed. So when it comes to volume, you really want volume to be at least 500 for that option strike contract, okay, for that option contract strike, just because you don't want a large bid to ask spread, okay? So volume, it needs to be over 500. Open interest kind of tells you the amount of open contracts that are still held, or contracts that are written by market makers. The volume tells you how many contracts are traded in the day. So it's a better indicator of liquidity, a better indicator of liquidity than open interest most of the time. And then bigger volume equals smaller spreads, okay? Low volume, you pretty much will start at a loss when the trade is executed. So be careful there. Anyways, that's all I had for today in terms of our fourth edition of this how to trade options and what are options. So if you want to see more, let me know, drop it in the comments, and I'll be glad to share more. We got more, just a few more parts to this series, and let's keep getting it. Good morning, welcome to the Fit to Flourish podcast. Let's talk wellness, finance, and growth.